Hi, welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you as always for giving us a few minutes of your time to understand what investors are thinking about right now and how that impacts on your portfolio. So we've been getting tons of questions on US policies, on the US economy, especially given some of the softer data that we've seen recently. So in this episode, I'm delighted to have our Global Chief Strategist, Dr. David Kelly, with us in APAC. And he'll be sharing with us some of his thoughts on the President Trump's policy agenda, impact on the economy, and of course, what does that mean for investors in our part of the world? It's a very timely get-together given the market volatilities that we've seen.
It certainly is.
So thank you, David, for joining us.
Sure, happy
to. I think let's start with the policy angle. So, since President Trump came into power for his second term, he started with over 70 executive orders as of this point, and various directives beyond those executive orders, including tariffs, cut back on some government departments, and obviously on the foreign policy. And from a market standpoint, what's been the impact so far? And what other policies, especially on the fiscal side, we should be watching out for in the months ahead?
Well, I think it's a very good way of putting it, because the first thing I think you have to do as an investor is divide those things which are sort of cultural or social that the new administration is doing from those things that can actually have an impact on the economy and therefore on markets. And so what I'd say is that there are 4 or maybe 5 broad policy areas that do have an impact for markets. One of them obviously is tariffs. A second one is immigration, because that affects labor supply. A third one is government cutbacks and government employment cutbacks and cutbacks in government spending. We've also got various forms of deregulation, and particularly perhaps less regulation on the banking system, although that's kind of indirectly coming from the administration. And then we've got a big tax bill which is likely to make its way through Congress over the course of this year, potentially giving the United States fiscal stimulus going into 2026. And all of these things are having an impact on the investment environment. They're all actually also having an impact on the thinking at the Federal Reserve, and therefore having an impact on short-term interest rates.
Now, we have seen some recent data on the consumer side, or consumer sentiment side, which has been a little softer. The US service PMI data is also dipped below 50 for the first time since the end of the pandemic. Treasury yields have fallen 2-year now below 4%. And also we've seen very modest widening of credit spreads, albeit from a really, really low level. Mm-hmm. Are we looking at a weaker US economy?
I think we are, at least in the short run. We have seen, for example, the Atlanta Fed GDP trackers actually turn negative for the first quarter, and that could happen. I think it is slightly overstating the weakness, but there's clearly a shift down in growth, and I think the part of this is on the government cutback side, because what we're seeing is a cutback in government employment, both buyouts and then layoffs, but fairly random layoffs. And then also we're seeing a lot of freezing of government spending and the potential for government spending cutbacks in different areas to try to fund future tax increases. And all that is feeding through to business confidence, to consumer confidence. And I think that news of all these layoffs is hurting consumer confidence. And then the second thing that I think is really important, and particularly important as we're recording this right now, is tariffs. I think the threat of tariffs is really weighing on American business, and it's causing people to hold back. Because I write something, as I think called Notes on the Week Ahead, and I put it out as my own podcast every week. And I wrote about tariffs, and the trouble with tariffs is they cut output, they increase unemployment, they increase inflation, they reduce productivity growth, they increase global tensions. Apart from that, they're fine, but they have and of course they increase inequality, and all of these things are very negative for the economy. But the uncertainty over tariffs, because the administration is saying something, and then a week later or 2 days later is saying something different, that is all of it having a chilling effect on the US economy, and I think that is making the economy slower. So right now I think it's a close call. We might end up with a negative quarter for the first quarter. We just have to see to what extreme these policies are taken in the second quarter to see whether this turns into something even more serious with the US economy.
Yeah, so you touch on tariffs and the potential inflationary impact, and when we review President Trump's pledges in his campaign, and you touch on again a number of key factors: tariffs, fiscal policies, immigration, deregulation, many of which are typically associated with high inflation. Some of the more recent inflation prints have also been a little sticky. As a result, the Fed seems to be quite happy with where its holding policy rates are right now. Now, I did remember that in the second half of last year, we thought inflation was coming down and gradually towards the Fed's target. Has all these new policies coming in or potential policies coming in changed your mind about how inflation could behave over the rest of this year?
I'm glad you put that last bit in over the rest of this year, because yes, it does change our view for 2025 somewhat. If some of these tariffs, particularly the most recent set of tariffs, stick, and that's a big if, then you will have a significant increase in inflation in 2025. But you're also going to slow the economy down. And some people have called it stagflation. But if we're going to be absolutely honest, it's really inflation stag. Because what happens is you have these tariffs push up inflation, and then over a period immediately, and then over a period of time they slow the economy down. Meanwhile, if the tariffs it's sort of a one-time inflation, so it pushes up the price level. But if the tariffs don't change from there, then you don't get any further feed through. But meanwhile, you've got this growing weakness in the economy caused by this tariff policy, which tends to reduce demand. And so if we have inflation, I think it'll be relatively minor if it's just coming from tariffs. But there are other things that could sustain it in 2026. If we had big fiscal stimulus in 2026, for example, that could sustain inflation. I will say that without government action, there is no reason why inflation should be high in the United States in the long run. We had 40 years before the pandemic where the inflation rate was basically flat to down. The United States is not an inflation-prone economy. But right now there are a lot of policies, as you just mentioned, which between immigration policies, tightening that up, and tariffs and fiscal stimulus, which are adding somewhat to inflation. So it makes us more nervous about inflation in the short run.
Interesting you mentioned the inflation stack part, because I think that's always the biggest challenge for central banks around the world. They've got, especially in the US, they've got two mandates. One is full employment, one is price stability. And when these two things are moving in the wrong direction at the same time, and the Federal Reserve in this case is only one tool. So if we do get into that inflation stack scenario, what do you expect the Fed's going to do?
Well, I think they're going to wait till they see the whites of the eyes of actual economic weakness before they do anything. Because really for two reasons. First of all, I think they fear that if you had a situation where you have massive fiscal stimulus in 2026, inflation could really begin to take off again, and the economy could escape whatever weakness it's seeing right now. And meanwhile, they would have cut interest rates too much. And what they're scared of, I think, is that they're going to get enough pressure from the administration as it is about interest rates. They don't want to be in a situation where they have to raise interest rates, having lowered them at this point. So I think they want to be sure they know the overall direction of all of these policies before they make another move on rates.
So with all that macro backdrop in mind, and we haven't had the best starts for U.S. equities in 2025. What will be your recommendations to our Asia Pacific investors on U.S. stocks? I think the Max 7 have been leading the way for the past couple of years. That concentration risk is something that we've been discussing for a lot on this podcast, and also through the Market Insights program for the past couple of months. So what's your recommendation on U.S. stocks, and also the overall asset allocation that will be suitable for investors in this part of the world?
Yeah, so I think the first thing is that people who are long-term investors need to still commit to long-term assets. And there's nothing magical about U.S. stocks. I know they've outperformed recently, but there have been periods of time when international stocks, when Chinese stocks, when Japanese stocks, when European stocks have outperformed too. But I think being in equities for the long run makes sense. I think there is a question mark around the valuations of U.S. equities right now, but particularly of those mega cap stocks, which just do seem expensive. And I often say, when it comes to a bear market, you don't know the hour or the day, but you do know the place. When you have a bear market in equities, it is almost always centered in the area that was most speculative, most bubbly in terms of valuations beforehand. I think that would probably play out this time too. So I think the first thing is stay invested in long-term assets, but recognize a stock is a stock, and it should give you better returns in the long run. You don't just have to invest in U.S. equities. You don't have to just invest in U.S. mega cap equities. You don't just have to invest in growth. If you're investing in value stocks around the world, that should give you a good return in the long run, and you can get in at much better valuations. The other thing I'd say is don't just think about stocks or even stocks and bonds. I think people need to be more broadly diversified. So one part of the diversification is try to lean against the concentration risk in portfolios. And but the other part of it is, include things like alternatives in a portfolio to it's not just stocks and bonds. There are a lot of alternatives which can also add stability to a portfolio.
David, you're very much a thought leader amongst U.S. financial advisors. I know you travel around the country, speak at conferences, and before you come to Asia in the past few weeks, what's been the top questions from U.S. financial advisors or investors? And also, what's the sentiment from these guys?
Well, I think the top question for a number of years has been about U.S. debt. I think a lot of financial advisors are worried that I think they're fundamentally free enterprise people. They don't really believe in big government, but they also read a lot of scary stories about government debt, and they're worried that the U.S. is going to run out of money and the government's going to go bankrupt. So those, and I don't think that's going to happen in the short run. I do think that bigger deficits put the United States on a more difficult path, and I think it's going to be, if you have a little bit of debt, you can be a little bit reckless. If you've got a lot of debt, then people have to really trust you, and so I think the United States the U.S. federal government needs to be a little bit more conservative in terms of behavior in this kind of environment. But that's what advisors have been primarily. That's the number one question I get asked. I do think that sentiment is changing a little bit, and I think one of the things that people are very receptive of is just a realization that, the last few years have been really good years for investors. If you go back 5 years ago, and if you were investing primarily in US equities, you might have had a goal as to how much money you wanted to make or how much you needed. And you've basically achieved that, and you've probably more than achieved that. But playing the investment game is about offense and defense. And it's kind of like if you're playing a rugby or soccer or American football, if you've racked up a good lead, then you really got to think about your defense. You want to make sure that defense is working. And I think this is a year to not just think about offense, but also think about defense. And that doesn't mean hide out in cash. It doesn't mean hide out in assets that are going to underperform in the long run. There's nothing wrong with diversifying into equities around the world and into alternative assets as a way of getting good returns even after inflation. It just means being careful about being overly concentrated in the overhyped, basically.
I think absolutely that's completely true, because I think a lot of Asian investors, what they don't do at the starting point is to rebalance their portfolio. I mean, we can talk about asset allocation, do you want overweight X or underweight Y, but the most fundamental investment discipline of just rebalancing your portfolio after, as you rightly said, made really impressive gains in a particular asset class like equities. I don't think that's regularly done.
And I think it's really something to think about. In the US version, we obviously we've got an Asia guide to the markets. We have also the US guide to the markets. One of the charts we added in there was a chart which looked at an allocation. Suppose you had an allocation with sort of 60-40 stocks, bonds at the start of 2019. If you didn't rebalance, you don't have 60-40 anymore. You've got 73-27. And so even after accumulating all this wealth, you didn't de-risk, you increased your riskiness. You were more exposed to markets, even though, frankly, you don't need to take as much risk to achieve your lifetime goals. So I think it's really important to be honest with yourself about how much risk you have. Because as I said, when a bear market hits, it's the overpriced, overconcentrated parts of the market that are most vulnerable.
I think that really reflects on the psychology of not just investors, but really anybody. Where you're on a winning streak, you think this will continue, and therefore, you may not want to rebalance. But the reality is, as you rightly said, as the risk accumulates, it requires that discipline to just bring you back to the appropriate level.
Absolutely, and I think investors need to be honest with themselves. I mean, the truth is, they don't need to have the best returns in the neighborhood. They just need to avoid having the worst returns in the neighborhood and have to move out of the neighborhood. I mean, it's okay. Financial markets will reward you richly in the long run. For steady investing, balanced investing, long-term assets. This is not a year to be greedy.
David, thank you very much for your time, and great to have you back in Asia. I look forward to have you again very soon.
Anytime.
So thanks for listening. If you have any questions or any comments, feel free to reach out to your JP Morgan Asset Management client advisors. And as always, if you find this useful, please share this with your friends and colleagues and consider subscribing. I'm Tai Hui. I look forward to see you on the next episode to discuss what's on the investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.